It was quite an eventful start to the year with a slew of news out the United States and China. So kickstarting off with the United States, we saw a mixed inflation picture over the month where we saw this consumer price index surprise to the upside relative to Bloomberg expectations, while the producer price index surprised to the downside. Nevertheless, both prints remain well off the highs seen in late 2022, so going forward we do expect the disinflation trajectory to continue, although it is certainly going to be a bumpy road. On the back of this, in line with the expectations, we saw the Federal Reserve keep interest rates unchanged at 5.5% on the upper bound. However, we did see some noteworthy takeaways from the meeting. First and foremost, we saw Powell rule out a potential rate cut in the March meeting, stating that he needed more evidence of inflation to be on a disinflation trajectory. Importantly though, he did state that most committee members believe that interest rate cuts are on the horizon later this year. What's important to note, however, is that the futures market is still pricing in deeper rate cutting cycle compared to what the Federal Reserve's own economic projections for the interest rate cycle to be this year and next. So we believe that the market is still likely to move closer to what the Federal Reserve are forecasting as per their latest dot plot. Another key takeaway from the meeting was the fact that discussions happened around quantitative tightening in terms of lightening up on the balance sheet runoff process. So while Powell did indicate that initial discussions did happen during the committee meeting, he stated that firmer discussions are likely to take place and more detail is likely to be obtained in the March meeting on the potential lightening up of the quantitative tightening process. So given the rundown that we have seen in the Fed asset side of the balance sheet, we're likely to see the gradient of the assets be less steep in a future state. Another important takeaway outside the United States is the fact that we got more information on how the US government intends to fund the fiscal trajectory from the quarterly refunding announcement. So as you can see, the government expects to fund a lot of the fiscal trajectory in terms of funding coming from the fronter end of the curve, i.e. the 2 to 5 year notes, so continued issuance is expected to take place there. We believe that the US government thinks that interest rates are likely to come off the highs that we have seen more recently because of intended rate cuts coming from the Federal Reserve going forward. Essentially what this means, by funding at the fronter end of the curve, that the effective interest cost of borrowing can be lower in the long run because of when refinancing needs to take place in the next 2 to 5 years, it is likely to be done at lower interest rate levels. We're also likely to obtain more information in March on how the US intends to fund more of the fiscus going forward, given the fact that the Biden administration did pass a short-term funding bill to keep the fiscus afloat in the near term to prevent a government shutdown. Over the month, we also saw the Taiwanese elections take place, where the Democratic Progressive Party reigned supreme. Fortunately, we didn't see much pushback from Chinese authorities in this regard. We saw a lot of stimulus measures take place from fiscal and monetary policy authorities to really reinvigorate the Chinese economy. First and foremost, we saw that the reserve requirement ratio for small and large banks was cut by 50 basis points. Essentially, this helps to free up liquidity for banks to be able to lend more in the hopes that credit uptake will stimulate the economy. We saw several other announcements such as easing of home buying restrictions, potential deliberations over buying back shares for state-owned enterprises to stem market losses. Essentially though, we need confidence to be restored in the Chinese economy such that consumers feel emboldened to increase consumption expenditure instead of increasing their savings trajectory. Moreover, we need to see total social financing, i.e. credit uptake, be a lot more buoyant going forward for the economy to be on a much more stable path going forward. At this juncture, we still see that the Chinese economy is quite fragile. However, with stimulus measures taking place, as long as the authorities address the property sector concerns that are very well known, as well as restore confidence back to the consumer, the Chinese economy will likely be on a more stable path going forward.